Welcome to the Opening Bell Report.
Today we're taking a scalpel to an analysis report focused on, well, one of the most volatile charts on Wall Street, the trade desk, ticker TTD. And when we say volatility, I mean we are talking about a stock that has had a massive, just a stunning valuation correction. This report, it kicks right off laying out the fact that TTD is down over 70% from its all-time highs.
70%. It's just a brutal number.
It is. As of today, January 16th, 2026, it's trading at what, $36.23? It's hovering right near its 52-week low of $35.65.
It is. And you know, that drama, that 70% drop is exactly why we need to do this deep dive. You have a market leader here. I mean, this is a key infrastructure player in digital advertising, and it's getting treated like some failing speculative startup.
Right.
And when you see that kind of divergence between the price and the actual company, the mission is pretty simple. Is this panic justified? You know, is it backed up by the reality of the business, or is the market just wildly inefficient right now? We really have to separate the macro fear from the micro fundamentals here.
Okay, let's unpack this. We need to figure out if this steep discount represents a spectacular buying opportunity, or if there's some kind of fundamental rot that Wall Street is seeing correctly. So let's start with the panic. The thing that's actually driving all this selling. The analysis is very clear on this. The immediate market concern is the macro narrative that, overall global ad spend is slowing down.
Right. The recession fear.
Exactly. That it's possibly heading into recessionary territory. And this fear is causing generalist investors, momentum traders, to just flee, which results in today's drop, right? Pushing TTD right near that critical low.
Right.
The market is just betting on contraction.
Exactly. And the most critical thinking step here is to acknowledge that fear first before we try to counter it. I mean, the market is effectively saying, who cares if they have cash if the ad dollars disappear?
Right. If the core business is shrinking, the cash doesn't matter.
That's the panic narrative. But then you look at the balance sheet, at the actual financial reality, and that narrative it fails to hold water. The analysis describes TTD as an absolute financial fortress. And that's a description that's backed up by objective metrics that address solvency, survival, regardless of some short-term ad slump.
Okay, so let's dig into what actually defines this fortress, because, a few bullet points aren't enough to justify ignoring a 70% collapse in the stock price.
Agreed. So first, let's look at the margins again. Their gross margins are still near 80%. 80%. This isn't some high-cost manufacturing business. It's a software platform with incredibly high profitability on every single dollar of revenue. So even if the top line slows down, the bottom line doesn't immediately just collapse into nothing because the variable costs are so low.
Which really speaks to the quality of the business model itself.
It absolutely does. Second, and this is crucial in a high-interest rate world, their debt level is zero. Zero long-term debt. This means all of their operating cash flow is being reinvested into growth, product development, maybe share buybacks, not just servicing creditors. And finally, that cash hoard. Over $1.3 billion on hand. But here's the nuance for you. The cash is substantial, yes, but the company has consistently generated positive operating cash flow.
So it's not just sitting there.
It's not stagnant cash, it's cash they are adding to year after year. It reinforces their ability to withstand all these recessionary fears that are driving the stock down. This financial posture means TTD is basically immune to the capital crunch that is just decimating its competitors right now.
That's a huge point.
Yeah.
So the market's treating TTD like it's this highly leveraged company facing a revenue crunch. But the financials show a company that can, in theory, just buy back its own stock for years using its cash flow while its competitors are struggling to make interest payments. It makes the repricing look, well, fundamentally detached from the business's health. So if the foundation is that solid, the question shifts to growth. What are the three core fundamental drivers that led this analysis to call TTD a strong contrarian buy right now? Here's where it gets really specific. Fundamental number one is the valuation reset. I mean, we have to address that ridiculous period where TTD was trading at a staggering price-to-earnings ratio of 100 times earnings.
Oh, 100 times.
Yeah.
It was a hyper-growth valuation for a perfect economy. It was unsustainable. And that valuation has been completely purged from the system, just washed out.
Yeah.
Today, the PE ratio sits at roughly 41x.
Which is still high, but...
It is, but let's put it in perspective. Think about buying a leading technology infrastructure stock, not some flashy app, but a core piece of the digital plumbing at half the valuation it commanded just 18 months ago.
Hmm.
For a company that consistently demonstrates growth and pretty much controls the programmatic advertising space, 41X is historically inexpensive, especially relative to its competitive position and its long-term trajectory. The growth premium is basically gone, which means any future positive news is going to have a much, much bigger impact.
So the market has given you a chance to buy a Rolls-Royce for the price of, I don't know, a mid-range sedan, comparatively speaking.
That's a great analogy. It really is. Now let's pivot to fundamental 2, which is the engine for future growth, the connected TV or CTV revolution. The data here is just indisputable. Major platforms like Netflix, Disney+, Hulu, they're all accelerating their push toward ad-supported tiers to bolster their revenue per user.
Okay, and everyone knows TTD is involved in CTV, but why is TPD specifically better positioned than anyone else? This is where we need the proprietary insight.
Absolutely, because TTD doesn't just power CTV. They solve the crucial problem of fragmentation for media buyers.
Fragmentation. Explain that.
Okay, so when a buyer wants to place an ad for a new car, they need to make sure you, the viewer, don't see that same ad 15 times across Netflix and Hulu and Disney Plus land.
Right. That's incredibly annoying and wasteful.
Exactly. And TTD's demand-side platform, their DSP, is the only neutral infrastructure layer that can manage frequency capping and deduplication across all those different publisher environments.
So they're the only ones who can see across all the different walled gardens.
That is their moat. It's technology like Unified ID 2.0, UID 2.0, that allows TTD to give buyers a consistent, measurable way to target consumers without relying on Google or Meta's data. In short, TTD makes all that fragmented CTV inventory usable for advertisers. So when CTV grows, TTD's indispensable role grows right along with it.
That makes the CTV revolution feel far less theoretical and much more central to their actual infrastructure. And that dovetails perfectly into fundamental 3. Recession resilience.
Yes.
Which links right back to that zero debt fortress we were talking about.
It connects everything. A recession doesn't just test companies, it changes the entire competitive landscape because TTD has zero debt and deep cash reserves. They don't just survive a downturn. They can afford to keep investing heavily in R&D and product enhancements.
And maybe even acquisitions.
Maybe even strategic acquisitions at depressed valuations. Think about their competitors who are carrying debt. They have to cut R&D. They have to slow growth. They lose their best engineers. The analysis implies that TTD will emerge from a recession not just intact, but having taken significant market share from its weakened, debt-laden rivals. This is an investment in cyclical dominance, not just cyclical survival.
So, if the fundamentals suggest we have an undervalued growth leader, the next challenge for a potential buyer is timing. You can't just ignore the technical pain of a falling stock, right? When might the selling exhaustion finally end? The report focuses on 2 signals that suggest the worst of the decline might be over. Technical detail 1 is the support level. The analysis indicates that massive technical support is forming right at the current trading range, that critical $35 to $36 level. This is where buyers have stepped in before.
And that signal is amplified by technical detail 2, which is momentum indicators. Now, we don't need to define the relative strength index for you, but the key is that the RSI is heavily oversold. And critically, the daily trading volume is stabilizing. So when you combine an oversold reading with stabilizing volume at a known support floor, it implies that the massive selling pressure is finally dissipating. The analysis calls this specific pattern a capitulation bottom.
A capitulation bottom.
And this isn't just, weak-hand selling. This is a sophisticated psychological event. It often involves forced liquidation, people selling stocks because they have no choice, maybe due to margin calls, or institutional investors making these final panicked sales to meet redemption requests. Once that forced selling is exhausted, the market just runs out of sellers, and any new buying pressure can reveal the trend very sharply.
And if that $36 level holds, the upside potential is massive. The analysis pegs a return to what they calculate as fair value at $50 or $60.
Right.
Based on those accelerating fundamentals we just discussed. That potential move represents a 50 to 70% gain from the current price.
Yeah.
It gives you a sense of just how stretched this valuation has become.
And that's the entire argument in one metric. The risk-to-reward ratio is considered absolutely skewed in favor of the contrarian buyer at this price. You have a floor, that firm $35 to $36 support line, which defines your maximum potential loss. And that's set against a potential 50 to 70% return, driven by the inevitable re-rating of a healthy, debt-free, market-leading business.
So this analysis, it provides specific tactical advice depending entirely on your investment horizon. For the short-term trader, the advice is classic caution. Don't catch a falling knife until a clear green candle confirms that technical reversal.
Standard stuff. Wait for confirmation.
But for the long-term, patient investor looking for a 2026 recovery play, the final conclusion of the report is firm. It's aggressive. It is a strong contrarian buy. The tactical summary from the report even provides a specific strategy for you. Start a position right here at $36, but hold back some capital and double down only if the market sells off one final time, bringing the price down to, say, $34. So what does this all mean?
It means that the conviction behind this aggressive call rests entirely on the quality of the underlying asset. The analysis is betting that the current panic over a short-term ad slump is overshadowing TTD's long-term infrastructure role. The core conviction here is that programmatic advertising on the open internet, it isn't going away. And neither is the trade desk, the company that provides the essential tools to make that whole ecosystem work.
It's a bet on structural necessity. But if TTD's future success is tied so intrinsically to the continued dominance and functionality of that fragmented open internet, we have a final provocative thought for you to explore. What technologies or platform shifts might fundamentally challenge that premise? We saw how strong the CTV bull case is, but what if a massive player, like an Apple or an Amazon, decides to build its own highly restrictive, proprietary ad operating system?
One that bypasses TTD's UID 2.0 entirely.
Exactly. That's the counter thesis you need to research next.
Don't forget to like, share, and subscribe for more.